Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, September 26, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is the U.S. consumer helping or hurting our paradigm C bull market? Our answer: this is fast developing into the $64 trillion question given the recent backup in Treasury yields and decline in near-term Fed policy normalization expectations. Indeed, the strong positive impulses in headline goods PCE growth, stabilization in services PCE growth, and declining personal savings rate in the August PCE report supported our resilient U.S. economy theme. The strong negative impulse in nominal disposable personal income growth in the August PCE report supported our U-shaped economy thesis. The strong negative impulse in nominal wage and salary compensation growth in the August PCE report also supported our U-shaped economy thesis. Recall that nominal wage and salary compensation is the broadest measure of income we receive from the labor market on a monthly frequency. As such, 3 consecutive months of below-trend growth for the first time since January of 2023 is bad and supportive of our U-shaped economy thesis. The weak positive impulses in headline, core, and supercore inflation in the August PCE report supported our sticky inflation theme. Reminder: inflation is by far the most lagging indicator of the business cycle and is unlikely to return durably to trend without an actual recession. This dynamic is somewhat de-risked because the Fed is already expecting inflation to accelerate over the next 1 to 2 quarters. Moreover, Wall Street consensus is expecting inflation to accelerate over the next 1 to 2 quarters. Wall Street consensus is also expecting inflation to remain sticky over the next 1 to 2 years. Further good news is for investors is that our sticky inflation theme is fully priced on a 1 to 2 year basis and fairly priced on a 5 to 10 year basis. Additionally, what if AI is structurally disinflationary as many expect it to be? Rates are headed much lower if the next Fed chair credibly weaves this into the debate surrounding the neutral rate, and commentary from key thought leaders like Rick Rieder, Kevin Walsh, David Malpass, Mark Summerlin, and others supports our call for regime change at the Fed. Note, each of these men are on POTUS's short list of potential Powell replacements. Deepening deflation in nationwide home prices, the largest weight in CPI and tied for the largest weight in core PCE, is an argument we anticipate will gain more traction in the coming months as well. Transitioning to our 42 macro dashboard, as always, we'll wrap up with the question from our community. This one's titled Dr. Mo. Says, hello, thanks in advance for anyone who takes the time to answer this. I'm answering it. Says, I can't seem to find what the different colors represent on the Dr. Mo charts. If someone can please share that, it would be much appreciated. So that's a great note to remind us, to remind our team to put some sort of key in here. So let me just bring this up for you guys. So when you go into the Dr. Mo section, you click on any one of the tickers across equity sectors, equity factors, global equities, fixed income sectors, and macro exposures. You can just click on any one of the charts. The dark green shaded area represents a long max position as signaled by our discretionary risk management overlay, aka Dr. Mo. The light green signals a long half position as indicated by Dr. Mo. The gray represents a neutral, a no position. That means don't be in the asset at the current juncture. No position equals gray. Red equals short max position, and orange. There's no short half positions for the equity sectors. Let me just find something that might have an orange here. Most things don't have short half positions because markets, for our institutional understanding of how markets function, is that they V bottom. And so a lot of times when we program the back test, we recognize that a lot of the positive performance came in short half positions when markets reverse and V bottom. So we just program that logic out of the Dr. Mo signals for equities, cryptocurrencies, commodities, and credit. All the sort of risk asset exposures within Dr. Mo don't have short half exposures for that particular purpose. So it's only capturing the downside risk associated with going into the crash as opposed to being late in the crash, and getting short squeezed and once the Fed starts to ease and we get those V bottom explosive moves. So I just want everybody to be aware of that. So again, as I mentioned, just click into any ticker. You can pull up the Dr. Mo signal for any particular ticker that you care about. There are 70 different factors across equity sectors, fixed income sectors, currencies, commodities, and crypto featured in our discretionary risk management overlay. Just kind of giving you guys a broader tour of the dashboard. If you click onto the VAMS chart from inside the pop-up, or if you click on VAMs here and just click on any one of the tickers, you can see what the volatility adjusted momentum signal condition, which is the core model that is powering our global macro risk matrix market regime nowcasting process, which feeds directly into our KISS model portfolio and our discretionary risk management overlay. You can see what those underlying model signals are for each of the assets you trade. But at the end of the day, what really matters is what KISS and Dr. Mo are telling you to do at this particular juncture. You don't have to worry about what they're going to tell you to do in the future. You can kind of program in your head what is likely to occur. But once you don't have to do anything until you get the change in signal, which will obviously get emailed to you if you're a 42 macro client, or obviously get posted here to the dashboard on a daily basis. And then apologies to our existing customers for displaying our KISS portfolio here in the macro minute, but I did want to highlight this as well since we're going through the signal section of the dashboard. So when you click into the KISS module here in the signal section, you can see the gross exposure, how we're currently allocated. And this is a function of the top-down and bottom-up risk management overlays that we feature in KISS to formulate this gross exposure here. You can see the percentage of maximum exposure right here. So we're at 100% of our maximum exposure, 60% in stocks. We're 100% of our maximum exposure, 30% in gold. We're 100% of our maximum exposure, 10% in Bitcoin, and have been for a couple of quarters now. Not a couple of quarters, several months now. If you click on the percent of maximum exposure tab, it'll turn into the beta adjusted S&P delta. So you can kind of toggle that back and forth to see. And so it gives you a sense of what this current portfolio configuration is in units of S&P based on the beta of these particular asset class, the beta and the correlation of these asset classes relative to the S&P. So a 30% position in gold is essentially a minus 0.3% position in the S&P 500. This 10% position in Bitcoin is currently functioning as an 8% position in S&P 500. And again, these change over time based on the trailing betas and correlations to the S&P 500. And then obviously a 60% position in SPLG is essentially a 60% position in the S&P 500. And then if you click on these tabs as well, you'll bring up the pop-up so you can see it a little bit more clearly. As someone who's getting close to 40, I'm starting to, I'm noticing myself leaning a little bit closer into my computer screen every morning. So I'm guessing my eyesight is starting to wane. So you can definitely click on those and bring the pop-up menu here. Again, percent of maximum exposure, beta adjusted S&P 500 delta, and then the overall allocations, current allocations for the KISS model portfolio. So, this is what we do. This is what has thousands of investors around the world, from some of the top PMs and CIOs across global Wall Street to, everyday investors on Main Street. They're just looking to retire on time and comfortably. They're all coming here to the signal section of the dashboard or to their inbox in terms of us emailing these signals when they change to, use these signals to stay on the right side of market risk via KISS and Dr. Mo. So just wanted to highlight that given this question today. And again, apologies to our paying Team 42 members for showing this today. We don't make a habit of that. Obviously, this is our bread and butter. This is what people pay us to do, and we do it at a very, very high level. So we'll wrap it up there. Darius here presenting our macro minute for Friday, September 26, 2025. Best of luck out there today, and have a great weekend. We'll catch you back here on Monday. Cheers.